Top 10 behaviors that hurt investors. Have you ever been stuck in a loop? A loop where you believe that you're doing everything right, but the results are still always nothing more than disappointing? Well, to tell you the truth, we've all been there. But it gets more and more frustrating if you lose your money every time this loop ends. If you're an investor, this situation might resonate with you a lot. It's true that investments are an effective way to grow your money. While it is important to make investments, even if they are small, it's more important to invest smartly. Many experts have discussed about the psychological or behavioral traps that lead investors into the wrong direction. Whenever we make an investment, there's already a risk of making a lower than expected return. But if we make more mistakes on top of that, there's a lower chance of us ever truly making a profit. In today's video, I'm going to explain some of the very common investor mistakes and how you can avoid them. So please make sure to watch till the end of the video in order to benefit from it completely. And before we begin, welcome to Invested Knowledge. Knowledge is power. So make sure to subscribe to this channel for up-to-date essential knowledge to become more successful in life and in business. By the end of 2020, the percentage of individual investors in the U.S. increased about 4% as compared to the previous year. The pandemic caused the stocks to become cheaper and savings account interest rates got cut in half. It was the perfect time for the bored people at home to try making investments. If you've recently started making investments due to the pandemic, it is likely that you may not have done it correctly the first time. This video is also for those investors who've been putting money to work for a long time and are tired of mediocre results. So strap in and notice if you're making any of these mistakes so you can avoid them in the future. Let's start. Here are some common mistakes you might have made in your investment career. 1. You invest without research. Before investing your hard-earned money, it's important to do some research about that investment beforehand. There are several aspects that you must consider before making your next big move, such as the risk involved in the process, any penalties or fees associated with it if you opt out of it early, and any fees that you may have to pay. Other than that, it's also advised to understand the business model of that company effectively. 2. Having identical asset categories. Professional and experienced investors invest in only a few positions and earn their required amount. However, common investors should not adopt this strategy because it involves a lot of risk. Make sure your portfolio is diversified and involves assets from many different companies. In this way, if any investments don't perform well because of economic factors, you can still get a profit from others. 3 is ignoring account statements. Ignoring your account statements can hurt investors because it's crucial to keep track of your investments, profits, and losses. Account statements are offered in print or online by banks periodically and offer an insight into your account activity and investments. Make sure that you take some time to read them. Figure out if the investments are bought and sold in the right way and how much profit you've earned or if there are any losses. This will help in cross-checking if the statement is right, and this practice will ensure that you're aware of how much money you've gained or lost. 4. Not reinvesting your profits. If you want to earn more profits in the long run, it's better to reinvest your profits from an investment along with the original money you invested. That is called compounding, and it's a guaranteed way to grow your profits over time. 5. Getting overpowered by fear. Fear is one of the most common reactions of human beings in response to any unwanted happening. As an investor, there will be multiple times when the stock market crashes or the stocks you invested in change greatly over a time period. However, you should not let your fear take the better of you. Make informed decisions that are based on rational thinking and are not driven by emotions. 6. Getting impatient. As an investor, there will be many times when you see that your stocks are not doing so well in the market. When you see this negative return, we recommend that you do not act impulsively and sell them when you could profit from these investments in the long run. Patience is the key for investors, and impatience can harm their financial goals. 7. Not developing a plan of action. Stepping into the investment world without having a clear map of your goals is one of the biggest mistakes that people make. A clear, comprehensive, and realistic plan of action will help you reach your goals, such as getting a new home or planning early retirement. When you make an investment plan, set realistic goals and divide them into short-term and long-term goals. Calculate how much money you'll need in total and how you can achieve that. Your investment plan should also entail the amount of loss you're willing to bear while making a decision. It should also include information about asset allocation, which is a personal decision and depends directly on your financial goals. Thus, not developing a policy statement can hurt investors. 8. The herd mentality bias. Let's assume you've been working all year long and now you're burnt out. You want to escape the mundane and hectic routine and are looking for a quick getaway. You hop onto Instagram and find out about all the travel bloggers and people spending their vacation in the Maldives. You book the tickets and hotels quickly, and when you get there, you realize that the sea is making you sick and a mountainous region would have been perfect. It is interesting to learn that humans are wired to believe that what other people are doing might be beneficial for them as well. In the financial world, we can get enticed by investments that everyone is talking about, from celebrities to YouTubers. Investing in these areas without having proper knowledge about them can harm investors. Make sure that you invest only in what meets your financial goals and not make any irrational decisions. Herd behavior can negatively impact investors because instead of making independent analysis and judgments, they rely on what worked previously for other investors. Thus, it's crucial to identify these biases and work on eliminating them. While making investments, it's important to keep your long-term goals in mind. If investing in Apple or Google is in vogue right now, but it doesn't benefit you in the long run, don't invest in them. It can be extremely difficult to go against what other people are doing, but it's best to stick to your own plan. 9. Not having a financial advisor. Getting help and guidance from a financial advisor can be beneficial because sometimes it gets tough to understand the stock market and its trends. When the market is crashing, we might panic and think about selling the stocks when they could earn us profits in the long run. Thus, having a trustworthy advisor can put our mind at ease and help us make informed and responsible decisions. 10. Being inconsistent. Consistency is important in all areas of your life, and this is especially applicable to the investment world. When you make an investment plan, it's important that you stick with it long enough to see the results. Some people get discouraged when they suffer from losses at the start, while others get greedy when they earn more profits than they thought and squander that money. We recommend that you remain adamant in your investment strategies and be committed to achieving your financial goals. You could also adopt a consistent strategy such as dollar cost averaging, where you invest money every week or month without worrying about the market situation. This will lead you to getting an average profit without suffering from massive losses. Investing helps you build wealth, so you don't have to financially depend on anyone after you retire. To beat inflation and gain healthy long-term returns, it's important to research well before you start making your investments. I hope this video helped you in pinpointing some of your mistakes and you benefit from it in the future. And that's all for today's video. Thanks for watching. I hope all the shared information will be helpful for you all, and if you have any questions or doubts, please leave it in the comment section. Don't forget to like and turn the notification bell on for more informative content.